Hello friends, welcome to your channel where I discuss the weekly market outlook in my video, and this channel is all about making you a far better trader than you were before you basically saw the ideas that I share with you in my videos. The one thing that I realized is that basically people seem to think that I am excessively cautious about the markets, and I tend to be very conservative. That's the feedback that I receive on my social media accounts. Well, last week should have told you why I'm cautious. Why I tend to look at so many things like interest rates, the dollar index, inflation, bond yields, etc., because all these markets are married to each other, and there is a pull and push in the markets, which I discuss with you using my in-house statistical model, the Barracuda, and its charts that it generates. So let's dive right in and discuss as to what's happened last week and how, at the end of the video, I share another study with you, how the Dow Jones Industrial Average, which fell more than 500 points on Friday night, can impact the Indian markets in the coming week. So don't go away, watch this video till the fag end, because I'm covering the US market index here. So as you can see on your screen, last week, as I advocated, retail traders unwound their long positions marginally, and that basically saw the Nifty and the Bank Nifty fall a little. Although I do admit I was pleasantly surprised and impressed by the quick-footed profit-taking by the newbie traders. I didn't expect them to be this quick, but in this video, we'll also see what this segment is up to now. The roundup, basically, as it shows you, tells you that there was more red, which is more losers, compared to the gainers last week as compared to the previous week, and this is because there were an overhang of some worries. The Bank Nifty continued to underperform the Nifty 50, and you know why. My regular viewers know it's a combination of the US dollar index, the 10-year benchmark bond yields, the consumer price inflation or the headline inflation, and of course oil and gas prices, which are multiplier commodities. Now these impact the prices of everything from milk, vegetables, fruits, grains, etc., and therefore impact the Bank Nifty and banking stocks directly. Here, bullion prices also fell because of a strong dollar, and because the dollar is the invoicing currency in the global commodity trade. Oil rose after the Robinhood conference, which I had covered in my Equity Master video. The links to the Equity Master YouTube channel are in the description below the video, and you should make it a point to subscribe to that channel, because I share 4 videos a week on my playlist there. So the Dixie, which is the US dollar index, rose a good 1.84% on a week-on-week basis, and that hammered the emerging market currencies, including the Indian rupee, as the USD INR shows you in this table. The 10-year benchmark bond yield rose marginally in spite of the GSAP, or the Government Securities Acquisition Program, which I mentioned in my previous week's video, and it was conducted on the 17th of June 2021. Now coming up on your screen is the MWPL, the Market-Wide Position Limits chart, which shows a very small gain on a week-on-week basis, which is actually along expected lines ahead of the derivatives expiry coming next week. Now, I had hinted that the peak of the MWPL is often seen in the third week of the derivative cycle in my earlier videos, and that is basically playing out well. Look at the basis chart on your screen. Both indices show a falling premium of the futures over spot because of a combination of selling and the approaching expiry next week, which eroded the premiums for both futures as well as options, call options alike. Option writers need to note this aspect of the basis and plan their option writing accordingly. Note the stock and index futures volumes on your screen now. The sell-off last week was accompanied by higher volumes, and do note that these are basically volumes of all three derivative cycles, which is June, July and August. So the sell-off was accompanied by higher volumes, which showed that the retail segment actually participated in the selling process. Now, which I feel is healthy, because an unprepared trader is invariably shell-shocked and sells in a panic, which results in steeper falls at a later date. Of course, some of this rising volume is also because positions are being shifted from June to July, but it's early days yet. That normally should accelerate after Tuesday next week. Now, let's take a look at the impetus chart of the Nifty and the Bank Nifty. I assure you, my friends, this and many other studies here shown in this video will be available only in this channel, because these are our in-house statistical model Barracuda's studies, which I share on my social media pages as well. Now, both the indices which I had shown you in the impetus chart last week as well have been showing weakness in the momentum, and even when the prices, for example, the Nifty was rallying towards 15,900 levels, the impetus chart of the Nifty and both the Bank Nifty and Nifty, as a matter of fact, were touching new period lows. Now, this period is 20-day look back period, and you can see that the impetus was actually sliding lower. Now, that's a red flag for momentum players and day traders. Watch this space and keep checking here for basically signs of updates here in this video every week. Now, let's take a look at the segment-wise footprints of the traders. Now, this is a study that's getting a lot of attention on my social media accounts, and I update this every day late in the evening. And if you connect with me on my social media accounts, my contact coordinates come at the fag end of this video. You can get yourself updates on this day after day. Now, let's take a look at the FIIs. FIIs reduced their stock futures longs as well as their index futures longs on a week-on-week basis. They are basically trading light. Now, let's take a look at prop traders. Now, these are self or proprietary trades of brokers who happen to be ahead of the retail traders where market directions are concerned. Remember, brokers are empaneled with many institutional traders, and therefore they know which way the wind direction is blowing. So they've reduced their stock long futures to 6-session lows, whereas they've raised their index futures longs to period highs, which is 20-day high period, which was actually net short last week. Now, what's in it for you? I think this is telling you something. The prop traders, who are actually almost after the insiders, the most knowledgeable guys out there, know that statistical beta or pure price volatility is higher in individual stock futures, and they are cutting exposure in stock futures and going towards the index futures longs. Index futures tend to be less volatile than stocks. Therefore, they are optimistic, they are net long, but they are trying to avoid volatility, and therefore they are playing safe. Now, let's take a look at the retail traders. Now, retail traders are guys like you and me. They've raised their stock futures longs to 6-session highs after being sellers last week. And they've also raised their index futures shorts to 6-session highs, which means that the retail segment is going into risk-on behavior. They are willing to take higher element of risk via stock futures long positions. Remember, that's high beta. Now, volatility in the markets is basically likely to go up as retail traders raise their exposure levels in the fond hope that higher risk should automatically lead to higher reward. Now, whether this will play out or not, the next weekly trading data will tell us. But do remember what I told you at the end of last week's video. The Jensen's measure, which is the favorite risk gauge of hedge fund managers, was warning against taking excessive risk last week. And you saw how the indices came under pressure. Now, let's note how the highly favored sectors like metals, cyclicals, autos and banks have come under heavy pressure after statistical signals flashed red flags last week. The coming days will show whether a pullback is in the offing or concerted buying by retail players can revive these sentiments. I will update this data every day on my social media accounts. Please feel free to connect with me there and get yourself updated day after day. Friends, let's now go to the 10-year benchmark bond yields, which shows that bond yields were staying firm, and as a matter of fact closed at 6.02% even after the GSAP on 17th of June, which mopped up benchmark bonds worth rupees 26,779 crores. Inflation concerns kept yields high, and the US Fed guidance, which was hawkish, also played a part. Now bond traders are eyeing the Indian Monetary Policy Committee meet in August for our own coupon rates. I will keep updating you on this aspect, so do keep connected with me on social media. But do remember, if you think interest rates are going to remain low forever and it's going to be a milk run, a continuous milk run, do note how the US markets went into a state of shock after the hawkish Fed statements. This is unlikely to last forever. So keep your ears to the ground. Ignore people who tell you that bond yields do not matter, or that the dollar index, inflation, oil and gas prices, etc. don't matter at all. It's your money. Play a very, very safe game. Friends, let's now go to the US dollar index known as the Dixie. And this benchmark currency index of the US versus the global basket of currencies saw a spectacular run last week, which I have been advising you since at least a fortnight. And I've been telling you that the 89.50 level is now a base. The implications for a thoughtful, knowledgeable trader is amply visible on asset prices across the spectrum. See how bullion fell, see how metals fell. Copper, which was trading above 800 comfortably, is now below 700. See the prices of nickel falling, see the prices of lead, zinc, etc. coming under the hammer. Aluminium, which was trading firmly above 206, 205, is below 192, 193 and unable to rise. So are stocks in the metal space. So don't ignore these signals just because people who don't know about them tell you that these are not important. My viewers have experienced by now that no asset class trades in isolation and there is a pull-push impact on each other. Now, the index chart on your screen shows you that this index rose on 4 out of 5 trading sessions last week with big prominent bullish candles. I wanted the 91.50 hurdle to be overcome, which actually happened last week. The price has closed above the 25-day exponential moving average since last week, but now it's even more comfortably higher. The April peaks on the daily chart will be the next meaningful hurdle for this index. Watch the weekly chart on your screen. The price has surged past the 25-week exponential moving average, which is heartening. And it's also happening to be the biggest weekly gain since September 2020. This will have an impact across all emerging markets, including India, and across all all asset classes. Keep watching this space keenly. Last week, I advocated a range between 91.55 on the upside and 89.55 on the downside, which was surpassed on the upside. The coming week is likely to see an estimated, I repeat the word estimated, range between 93.35 on the upside and 91.10 on the downside. Friends, let's now go to the Bank Nifty. This banking benchmark remains an underperformer since a couple of weeks, and you know why. As compared to the Nifty, it's well below its February highs on the daily chart on your screen. It shows the price sliding back below the 25-day exponential moving average after spending almost a month above this average. Now that's one red flag which you've got to note. The price itself is at its lowest after 21st of May 2021 in the spot segment. This index fell on 4 out of 5 trading sessions last week, which highlights the prevalent weakness in the undertone. The weekly chart on your screen shows a second consecutive week of declines after an inverted candle 3 weeks ago, inverted hammer candle 3 weeks ago. The price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive for now. This index is more sensitive to external variables like the dollar, oil and gas prices, 10-year benchmark bond yields, inflation, and these are something that most retail traders tend to ignore or unfortunately are not aware of. But they would, to their advantage, start monitoring these. The week before last saw this index at number 5 of the most volatile list. Last week it rose to number 4 because beta or statistical volatility rose. Last week I advocated an expected range between 36,625 on the upside and 33,450 on the downside, which held perfectly well in spite of all that volatility that you saw last week. The coming week is likely to see an expected, I repeat the word expected, range between 36,150 on the upside and 32,950 on the downside. Should unwinding of long positions escalate, this range runs the risk of being overcome on the downside. So continue to trade cautiously and preferably on small volumes. Please adhere to strict stop losses because the risk of volatility is fairly high. Friends, let's now go to the Nifty 50, which is the lowest impact cost index, a tradable instrument on the NSE derivative space. This benchmark index fell on 3 out of 5 trading sessions, as you can see on your daily chart, but it was relatively better placed than the Bank Nifty in terms of percentage losses. The price tested the 25-day exponential moving average but closed above this level on Friday. The previous high of February has been overcome, but selling on advances is fairly noticeable. Most of the constituent stocks of the Nifty 50 are under pressure, which may be a worry in the coming days. At the end of this video, I'm going to analyze the Dow Jones Industrial Average chart and gauge its impact on our domestic markets next week. So don't go away. Do continue watching this video till the fag end. The intraday low of Friday was its lowest after 31st of May 2021, which means we've seen the calendar month low of June on Friday. The price action suggests sluggishness, which we saw even in the impetus chart, remember, which was at its period low of 20 days. There must be an immediate rise in buying momentum if the bulls are to get back in the driver's seat again. The 15,900 round number, which was the previous week's high, is a rough and ready immediate obstacle which the bulls must overcome to convince the broader markets that, hey, the bulls are back and they're serious of an up move. Now watch the weekly chart on your screen. Note the bearish hammer formation which has occurred at the peak of the up move, which makes the high of 15,902 as a litmus test for the bulls to overcome. The price still remains above its 25-week exponential moving average, which means the medium-term outlook remains positive for now, only for now. Do note that the moving average will continue to rise daily as the price gets updated, so the hurdle rate for the bulls will keep rising. That makes the challenging job for the bulls even more challenging in the coming week. And on the flip side, a sustained fall below the 15,450 level, which was last week's low, can trigger fresh nervousness in the markets. In the week before last, this index was number 20 on the most volatile list, but it slipped 2 notches to number 22 because volatility fell due to smaller ranges. Last week, I advocated a range between 16,215 on the upside and 15,375 on the downside, which held perfectly well in spite of the high volatility in the markets. The coming week is likely to witness an estimated, I repeat the word estimated, range between 16,150 on the upside and 15,200 on the downside. Now, the Jensen's measure, which hedge funds use to calculate whether taking on an additional unit of risk is likely to yield more than an additional unit of reward or profit, remains skewed as it was last week against fresh, aggressive leverage long positions. Remember, I'm not telling you not to buy. I'm just telling you don't be too aggressive and don't leverage yourself too much. So you can continue to trade on lower exposure, and you should adhere to strict stop losses diligently, and also watch the Dow Jones analysis at the fag end of this video. Now, my friends, I come to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high impetus stocks that you can trade on small exposure, wait for large price moves and make your money, and 5 stocks which are low beta, low impetus, where you take big ticket exposure, wait for very small price moves to make your money. Different traders, different mindsets, different aptitudes. So I'm basically trying to help both segments of the traders take their picks. The high beta, high impetus stock list is led by Mahindra & Mahindra at number 1, number 2 Hind Unilever, number 3 GMR Infra, number 4 Asian Paints, and number 5 Marico. The low beta, low impetus stock list led by PVR at number 1, number 2 United Breweries, number 3 Titan, number 4 Muthoot Finance, and number 5 IRCTC. Do note, my friends, that this is a dynamic list, and as volatility changes day to day, the hierarchy of these stocks will also continue to change. Now, before I sign off, let's see the Dow Jones Industrial Average chart on your screen. This is a daily chart, and it shows the price action from March 2020 after the lockdown was imposed. Do note how the price flipped above and below the 25-day exponential average, but it stayed above the bullish trend line. Starting Thursday last week, this trend line has been violated for 2 consecutive sessions, and the previous swing low near the 33,500 level has also been violated on a closing basis. A dip to the 32,500 may become a possibility if the declines persist. Now, the fact that the Dixie, which is the US dollar index, is also rising at the same time as the Dow is falling, makes the outlook even more challenging for the domestic markets. If global cues are to stop bothering the domestic bulls, the Dow Jones Industrial Average must climb back above this trend line and above the 25-day exponential moving average, which means the Dow must climb above 34,500 or even higher to bring the derailed train back on track again. Keep watching this space for cues on emerging markets, including India, because we do get impacted by the Dow. Now, friends, I bid goodbye to you in this video, not before reminding you to click like on this video, subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put about here. I'd love to hear your feedback in the comment section, so keep me posted about what you think of this video. Also, help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. In the description below the video are hyperlinks to Equity Masters YouTube channel and also a link on how to get a free guide to becoming a better trader. I wish you have a very, very profitable week ahead, my friends. Do take very good care of your health and trades and investments. Thank you for your patience and watching my video. Till I see you again next week, take care. Bye-bye.